Bank of Japan Governor Haruhiko Kuroda's stimulus policies are backfiring in Japan's housing market as mortgage rates are rising even though the central bank is flooding the financial system with cash. Carl Weinberg, chief economist at High Frequency Economics, joins me on the line. Carl, what is the danger of rising mortgage rates for Japan's economy?
I think what Japan is experiencing right now is a transition to a new monetary policy, to a new strategy for bond acquisition that has caught the market by surprise. In the very near term, the Bank of Japan is buying more longer-term bonds and fewer shorter-term bonds, and that's having one impact on the short end of the yield curve. And at the longer end of the yield curve, I think that people didn't expect that the package would be as small as it is, which is not to say that it's small, but a bigger stimulus package was expected compared to what the Bank of Japan had been doing before. I think these are transitory. The Bank of Japan buying a total of about 30 trillion in additional yen worth of JGBs every year has to have a positive impact on bond prices over time.
Kuroda has unveiled a plan to buy more than 7 trillion yen of Japanese government bonds a month. Some analysts are saying BOJ's buying is reducing the liquidity of government bonds, preventing market participants from finding appropriate yield levels. Do you think this is true?
I think it probably is true. Certainly they are taking up a lot of the new supply that normally would go to financial institutions. The whole point of the program is to hold down the yields on JGBs, to raise their prices so that market yields on bonds will be lower, so that in turn will bring down borrowing and lending rates in the economy. So for sure, if dealers are complaining that supply is tight and prices want to go higher, the policy is succeeding.
The BOJ also says it will increase consumer prices. Is this a good idea?
Well, I think there are two questions to that. The first is whether they can increase consumer prices by following this policy, and the second is whether it's a good idea. As far as whether they can, I don't think that they can create inflation simply by increasing the supply of money. Monetary accommodation is necessary for inflation to occur, but it's not sufficient by itself to make inflation happen. In a case like Japan, any extra demand that's created by printing money on such a large scale, we at High Frequency Economics believe will not create new output in the economy, but since output is constrained by a contracting labor supply, it will instead create more imports. So if the vent for excess demand is imports, you won't get any price action out of this kind of monetary policy. Now, if they could increase inflation, or I should say end deflation, and get a positive inflation rate, would that be a good thing? Yes, I think so. Japan has a severe challenge in its public sector finances. Its debt at 2.5 times GDP is huge, and it gets bigger every year. But at the same time, if we have a deflation, incomes of being earned by the economy that are being taxed and otherwise tapped into to finance that deficit, they continue to get smaller. So the debt burden tends to be increased on a per worker or per capita basis if prices are falling. Deflation penalizes people who save, and that's a problem.
And Kuroda expects to reach 2% inflation in 2 years. Do you think this is achievable?
No, I don't think so. As I said in my answer to the last question, we believe at High Frequency Economics that all he will do is stimulate more imports to fill any excess demand that's created.
That's all for now, but stay tuned to Dukascopy TV for the latest financial news and updates. Goodbye for now.